Hello, everyone, and welcome to the 2021 Virtual Northern Virginia Housing Expo. This is our 11th year offering education, resources, and connections for those interested in housing issues and affordable housing opportunities in Northern Virginia. Today's workshop is titled Understanding Mortgage Speak and will be led by Michael Lett, a mortgage sales manager from U.S. Bank. Today, he will explain the important acronyms you will encounter in the mortgage loan process and what role they play in your loan process. If you have any questions, please use the question mark button on the right side of your screen to ask it. A recording of this webinar will be posted to our website and Facebook later today if you know someone who wasn't able to make it this morning. All right, Michael, take it away.
Thank you. Good morning, everyone. Thank you for coming out this morning. My name is Mike Lett. I'm the sales manager for the Washington, D.C. metro area that includes Northern Virginia and parts of Maryland. I've been with mortgage for probably about 30 years now. Most of my experience is with a lot of the larger banks, and I think I've seen just about every loan scenario and every type of borrower possible. So I think I'm pretty qualified to share some very valuable information with you this morning. With that, I'd like to get started. And if you have any questions, I'm sure you know how to ask them in the chat line, and I'll be glad to answer them for you. So the first thing, I want to congratulate all of you for taking the time to come out this morning. I know it's very sunny out. It's a beautiful day. You probably want to be at the pool or at the beach or something. And I just thank you for taking the time to come out to this very valuable expo that'll give you a lot of information that'll prepare you for your home buying process. Today, we're going to provide information and tools that you're going to need to become an educated home buyer. You know, you're probably coming in with some preconceived information now, but you're just not sure what steps to take next. Hopefully, with this information, I'm going to provide you with those next steps and also give you some understanding of some of the terms that you're going to hear in the mortgage industry when you're talking with me or you're talking with a lender or anybody. So the name of this presentation, as you know, you saw in the beginning, was Mortgage Speak. What that means is we're going to talk about all the different types of mortgage terminology that you're going to encounter while you're going through the process of purchasing a home. And what does all of this mean to you? You know, you're going to hear terms like DTI, LTV, PMI, PITI, FNMA, Fannie Mae, HUD, Freddie Mac. Those are very, very confusing terms. And we want to make sure that we provide you with this information this morning so that when you're talking to your lender, whoever it may be, you'll have a much better understanding of what those terms need and how they apply to the type of loan that you're going to do. So with that, let's dig into this thing and get going. Are there any questions at this point?
We don't have any questions at this point.
Okay, great. So the first term we're going to talk about is DTI, or what is normally called debt to income. And what is DTI? So DTI is how the processors and underwriters calculate how much you can qualify on a mortgage. You've probably been asked by a lender to provide W-2s, pay stubs, bank statements so that they could calculate your DTI. And this is very, very important. This tells the lender how much you can qualify for the house. What I want to share with you today is some information to help you to be able to calculate that DTI, even if you're at home, which would really help you. Okay, so in order to first talk about DTI, I want you to understand that there's two parts of DTI. There's your front end ratio, it's called, and your back end ratio. And these two calculations help the lender determine, based on your income, how much of a mortgage payment you can qualify for, and then based on your income and your other credit obligations, how much you can qualify for. So let me explain that a little more in detail. So with your front end ratio, the bank looks at your total monthly house payment. Now we're talking about the house that you're looking to purchase. So they're looking at what that total monthly mortgage payment will look like with your taxes and your insurance included. And they want to divide that by your income. Now, when we're talking about income, we're not talking about your annual income. We want to break that down into a monthly figure. So you're going to divide what that total monthly mortgage payment will be by your gross monthly income. And that's going to give you what we call your front end debt ratio. Okay, so let me go through that one more time for you, maybe you might have a pencil paper, you want to take some notes on that. So you want to divide what the proposed housing payment will be with your taxes, insurance, mortgage payment built in, and you want to divide that by your gross monthly income. And that comes out into a percentage. And you want that percentage to be probably between 28 and 33%, which is an allowable debt to income ratio. Okay. So that, again, that's what we call our front end ratio. Now, the second ratio is called our back end ratio. The way we look at that is we look at, again, your total monthly house payment, and we add in whatever monthly obligations that you have that are reflected on your credit report. Let's say you have credit cards and you have a monthly payment of $100. We want to add that on top of your mortgage payment. You have a student loan. You have a $100 month payment. We want to add that on top of your monthly payment. So we take all of those credit obligations with your total monthly housing payment, and we divide that again by your gross monthly income. Okay, we want to see a ratio for that back end ratio of around 36%. It can go up as high as 41% with some lenders. So I want you to also understand, all lenders calculate these DTIs a little different. The calculation is the same, but some lenders accept the higher DTI, or they accept they might not accept a DTI in excess of what I'm giving you. Just to give you an example, so for a front end and a back end ratio, what would be very good to have would be in the area of 28% on your front end ratio, 36 on your back end ratio. Not to say if you calculate it and that ratio goes up, say, to 40 or 45%, there are lenders that will accept those ratios. For an example, if you're doing an FHA loan, which is a first-time home buyer loan, the ratios, acceptable ratios, are higher. They're 33% on the front end and 41 on the back. Now, let's say we're in the DC metro area, the values are a lot higher here. Let's say you're buying an $800,000 house, which is a jumbo. Now, the ratios can go up as high as 43%. So again, DTI is very, very important for the processor and the underwriter to determine how much of a house you're going to qualify for. The next term you're going to encounter is called LTV, or loan to value. And what is LTV? Well, LTV is basically the difference between let's look at it this way. If you're purchasing a home, it's the difference between the sales price that you're trying to pay for that house and the loan amount. Okay, so let's just say you're trying to buy a house for $500,000 and you want to put down 10%. So 10%, again, think of it as the highest LTV is 100%. So if you're putting down 10% on a house, your LTV is going to be 90%. So your down payment is 10%, which means the bank is going to finance 90% of that loan. Okay. And again, that's very important when you're looking to buy a house, how much your down payment is going to be, because it's going to affect a lot of things. It's going to affect how much your monthly payment is going to be, and it's going to affect the type of loan that you can qualify for. So how do we calculate LTV again? Okay, if we're purchasing a home, we look at the sales price, we look at what our down payment is going to be, and the difference is what's left over is going to be your LTV, or your loan to value. And that's how you would calculate that. Now, one thing about loan to value, most people want to avoid having to pay mortgage insurance. So when you're looking at loan to value, if you put down a payment of 20% or more, then that's how you're going to avoid the mortgage insurance. So again, that's where LTV becomes really important. LTV is important on an FHA loan also, whereas you're not putting down 10%. The loan to value or the down payment requirement on an FHA loan might only be 3.5%. So now, if you subtract that 3.5% from 100%, now you've got a 96.5% loan that the bank will finance for you. Okay, so just always remember, if you purchase a home, the LTV is the difference between what the price of that house is and how much money you're going to put down as a down payment. Okay. So another term that you're going to encounter is called PMI. What is PMI? PMI is mortgage insurance. So PMI is basically the government requires banks to have PMI on their loans to ensure the title and to protect the title on the loan. This doesn't do much for you, but it does protect the banks, and the banks require it. Now, when is PMI required? So PMI is required when there's there's more than 80% equity on the property. In other words, if you're buying a home and you put down less than 20% as a down payment, normally you're going to have private mortgage insurance. Now, there are lenders, again, this is not locked in stone. There are lenders out here that have programs that if you put down 3 or 5%, that you can avoid PMI. These are special types of programs. But just always remember the calculation, or the rule of thumb is, if you put less than 20% down when you're purchasing a property, then you're going to absorb private mortgage insurance. Now, how long do you have to keep this private mortgage insurance? Well, that depends on the type of loan that you're doing. If you're doing a conventional loan and you bought a house, and let's say you put down 10%, so you have a 90% loan to value. We talked about that on the previous screen, but now you have private mortgage insurance. So with this private mortgage insurance, you have an extra payment that is added to your mortgage payment. Now, once there's a couple ways. If you put a little more money down on the house at a later time, or the value has increased and appreciated in the property, that now you have, say, 20% equity in the property, then you can eliminate having to pay that private mortgage insurance. Okay, it doesn't happen automatically. People always ask me, well, Mike, if my house appraises, how am I going to know? Well, you kind of have to watch that on your own and see what the market is doing. And if you think that your neighborhood is appraising in value and you've gotten to that point, you just want to call your lender and say, listen, I think I've got 20% equity now in this property, and I want to see if I can eliminate the PMI. And they will look at it, they will do an internal evaluation, and they will let you know. Now, with certain loans, like let's say, for example, an FHA loan, which again, I told you was a first-time homebuyers type loan, you don't get rid of your private, it's called mortgage insurance premium, but you don't get rid of it. So the thing with FHA loans, you will have mortgage insurance, and that mortgage insurance will stay on your loan for the life of the loan. So the only way you can get rid of it, you would have to refinance out of an FHA loan, let's say, into a conventional loan. Okay, so always remember, again, when we're talking about PMI, it doesn't really benefit you as the borrower. It's more there for the lender to protect the lender, but you will be required to pay it normally if you're putting down less than 20% when you buy a home. Okay, now let's just talk real quick about the private mortgage insurance types. So we talked about, and I want to make sure this is clear for you. We talked about upfront mortgage insurance, and there's different terms: borrower paid mortgage, lender paid mortgage. So as I said, with private mortgage insurance, you know you have your monthly mortgage payment, you have your tax payment, and you have your insurance payment, your regular homeowner's insurance payment. So when you have PMI, the bank calculates what the payment is going to be for that mortgage insurance. Now, there's a couple ways that can be paid. There is a thing called borrower paid and lender paid. So some lenders offer a program with lender paid mortgage insurance. And what happens with this is they will absorb the cost of paying off that mortgage insurance for you. But what happens, of course, they're not giving you giving it to you for nothing. So what happens is the interest rate that you're normally paying on a loan will probably be increased. And the difference between that higher interest rate and a lower interest rate is what the banks will use to pay your mortgage insurance, your upfront mortgage insurance. And what does this do for you? What's the benefit? Well, the benefit is that as long as that higher interest rate has a comfortable mortgage payment for you, you won't have to worry about paying that monthly mortgage insurance, okay? Because it will have been paid by the bank. The other way is just called borrower paid mortgage insurance. And again, it just means that that extra payment will be added to your loan until you've accumulated 20% equity in the property, and then we can get rid of it. Now with FHA loans, it's a little different. So they have a thing called upfront mortgage insurance premium. So they charge an upfront amount. I'll just give you a calculation of 1.75 that you would calculate times your loan amount. And you pay that upfront. It's part of your closing costs. And then there's also a monthly payment that will be added to your monthly mortgage if you're doing an FHA loan. Okay. Okay, so the next term we're going to talk about is PITI. You probably heard the term PITI, P-I-T-I. What PITI is, and all of this is kind of flowing, as you can see, every screen is kind of flowing to what we talked about in the previous screen, okay? Hold on one second, I just made my screen too big here. Okay, let me see, give me 1 second there. Okay. So we talk about PITI. PITI, the acronym for PITI stands for Principal, Interest, Taxes, and Insurance. So your total monthly mortgage payment when you buy a house is going to include these 4 things. And this is what your underwriter processor is going to use to calculate your debt to income ratio, your loan to value ratio, all of those things. We're going to look at your principal, interest, taxes, and insurance. Okay. We look at this as a monthly amount. So again, when I was teaching you about DTI, debt to income ratio, and we talked about your total monthly payment divided by your gross monthly income, this is how you want to calculate it using this. Now, if you haven't bought the property, you're not going to know exactly what the taxes are, but there are ways to go online, and we could probably talk about that at another time, or you can ask me that question. There are sites that you can go on to figure out what the estimated property taxes would be in the area where you were going to purchase a property. Same for homeowners insurance. You can kind of calculate pretty easily what it would cost for your homeowners insurance. So this is just a way for you to be able to calculate what your monthly mortgage payment would be. Okay, so the next term we're going to talk about that you may hear, you've heard the terms Fannie Mae, well, FNMA, that stands for Fannie Mae. FMHLC stands for Freddie Mac, and HUD stands for HUD. So these are government agencies that regulate the mortgage industry, the underwriting of the mortgages. It's also called our secondary market. I don't want to get too really confused with this, but just understand that these are the government, these are the government organizations that regulate all the terms of the loans, the different guidelines, the different changes in loans. And it's just good to know when you hear Fannie Mae or Freddie Mac. Normally, if you're going to buy a home and use a conventional loan, it's either going to be using what we call Fannie Mae or Freddie Mac guidelines, okay? And your lender can tell you a little more about each one of these. But basically, what you want to know is that with mortgage companies and banks, when they get a certain number of loans in their portfolio and they need to move them to make room for new loans, these are the agencies that they sell those loans to. Now, Fannie Mae receives loans from like the bigger banks, like the Bank of America, the Wells Fargo, the SunTrust, okay? Freddie Mac receives those loans from your smaller mortgage companies and your smaller banks. That's the difference. Now, HUD, which is Housing Urban Development, is your government, again, your government agency, and they deal with just government type loans on government properties. Okay, but again, so you hear these terms, Fannie Mae, Freddie Mac, HUD. If you need any more information on what those are, how they operate, you can definitely ask your lender and they will definitely explain them to you. So the next thing we're going to talk about is AUS, DU, LP, and GUS. What this is the automated underwriting system. What that is I'm sure that if you've ever tried to purchase a home or you talk to a lender, the lender will tell you, they ask you a series of questions. They may even have you fill out an application. And once that's been completed, they submit your application into an automated underwriting system. This is how, without the underwriter or processor physically viewing all your documentation, that we're able to get a preliminary approval or denial or or any type of answer on your loan before the documents are even provided. The first term is desktop underwriter, and that's just used for most conventional loans. And that what it is it's a system that looks at all the information that you've already provided. So let's say you're talking to your lender, you've given them your income, what your income is for the year. You've told him how much money you have in the bank. You've given him consent to take a look at your credit profile. All of those pieces of information are gathered, and now the loan officer is able to submit that and run what we call a desktop underwriting automated decision. Now, if you get what we call accept eligible, it means that your loan has preliminary been approved. And the approval will also show what documentation is needed to make it the final approval or get it to the closing. So this is very valuable for you, that if you're able to get that accept eligible decision right from the beginning, it gives you an idea that, yeah, I qualify for this loan. I've been approved for this loan. Now I just need to provide the rest of this information to my lender to complete the process. Loan prospector. That's normally, again, that's an automated decision engine underwriting system, but that's normally used for FHA loans. So if you're doing an FHA loan and they're trying to get an automated answer, an automated approval for you, they're normally going to use loan prospector. The last term is GUS, we call GUS, or government underwriting system. And again, that's just used for a loan called a USDA, which is 100% financing. Normally, those kind of loans are used when you're buying a property with a lot of land, like in rural areas. Okay, but just understand that every bank, almost all mortgage companies have this system, and where they are able to give you an answer on your loan even before submitting a lot of your documentation. Okay, so the next term we have is, you see, VOE, VOR, VOA. Sounds really, really confusing, doesn't it? So VOE is your verification of employment. Verification, VOR is your verification of rent, I'm sorry. And VOA is verification of assets. So this is information that the lender is going to ask you to provide. So again, they can determine how much you qualify for with your income, or if you're a renter, how much you're paying for rent and how that ties into qualifying for your mortgage, and also your assets, your bank statements, your retirement accounts, any type of liquid or non-liquid assets that you have. Now, this is important because the mortgage industry has gone through a lot of changes, in that it used to be, I've been in the business almost 30 years, so I consider myself an old school loan officer, where we had to collect all of this information, your pay stubs, W-2s, tax returns, everything. Well, the mortgage industry has gone through a lot of changes, and there are things called digital platforms now. These digital platforms enable mortgage companies and banks to be able to acquire this information electronically without you providing the documentation. And what does this do? It just streamlines your process and makes your approval process a lot quicker. Because with verification of employment, as long as all the correct information has been added into your application, and that's your lender's responsibility to do that, as long as that information's been added in completely, that lender is able to acquire all the information about your employment. The same thing with your rent. If he has all the information about your landlord, he can acquire everything electronically for your rent. And assets, the same way. Now, I want to caution you, banks do not have access to your funds. We do not touch your funds at all. This is a very secure process, but as long as you add all the information in the system about your bank accounts, if you have 401k, mutual funds, any type of liquid or non-liquid assets, if the system allows it, the digital platform that's being used, we can acquire the information on those assets. Again, this just makes your process, your mortgage process, a lot more simplistic. It moves a lot quicker through the system when we're able to gather this information for you. And again, just remember, you will be signing or agreeing or giving consent for us to give this information, for us to provide this information for you. So you will have to give your lender consent before he can do this, okay? Okay, so let's just quickly talk, oh, I'm sorry, that one. Okay, let's just quickly talk about a couple types of loans that you're gonna hear about. Okay, you're gonna hear about fixed rate mortgages. So normally, when you decide you wanna purchase a home, you're gonna take out a loan, normally I would say for 30 years. You might take out for 20 years or 15 years. And just understand that your monthly payment will be fixed for that period of time. So if you take out a 30-year loan, you're planning to live in that house for a long time. Your payments are not going to increase. They're not going to change. And so you're going to, you're going to have a 30 or a 20 or a 15-year loan. And this is called a fixed rate mortgage. Okay. This includes your monthly principal. We talked about PITI, P-I-T-I. That mortgage payment will include your principal, interest, and your taxes and insurance. It'll all be built into that payment. So the second type you've probably heard about is called an ARM, or an adjustable rate mortgages. So one thing about these interest rates, they do have the capacity to fluctuate at a period of time. There are also ARMs that are called what we call a convertible ARMs. So one thing to keep in mind, if you're ever considering taking out an adjustable rate mortgage, it's going to be based on the time that you think you plan to be in that home. So let's say you're in the military and you're coming to a base, you're only going to be there for about 3 or 4 years, but you still want to buy a property. Well, you're probably going to want to take advantage of an adjustable rate mortgage because it's a shorter term loan, and normally the interest rate is going to be a little lower also because it's a shorter term loan. Now, there are ARMs called convertible adjustable rate mortgages. And what that means is that you've probably heard some negative things about adjustable rates, in that the rates will fluctuate on a irregular basis. Well, with a convertible adjustable rate mortgage, that rate is fixed for a period of 3, 5, 7, or 10 years. So let's say you wanted to do an ARM, you thought you're going to be in that property about 5 or 7 years. You could take out a 7-year loan. Your monthly payment will be fixed. It will not fluctuate in that 7 years. It will be locked in for that 7 years. Now, at the end of the 7 years, if you're still in that property, then there will be an adjustable rate period. And each bank has a different type of program, and they can talk to you more about that, about how that adjustment will occur at the end of the period. But just understand that there's benefits, good things about doing adjustables, and there's bad things. I mean, again, the rate is subject to change, but if you have a convertible adjustable rate mortgage, you could take it out in a fixed rate period of time. Okay. The next loan you'll hear about often is FHA. So FHA is really used for first-time home buyers. Why is that? It has a lower down payment requirement, which is 3.5%. Okay, some banks require 5% down, 10% down, 20% down, depending on what type of program you're going to take out. But with an FHA loan, you can put down as little as 3.5%. Other thing is that the credit guidelines are a lot more relaxed for FHA loans. So they take into consideration that if you had a couple of late payments and you can explain why those payments are late, they'll take that into consideration, and there's a good chance that you could still get approved for an FHA loan. We also talked about debt to income ratio, DTI. So with an FHA loan, they actually will allow for a higher DTI. You can go up probably as high as 45% debt to income ratio. So when you look at the calculations that I taught you earlier about debt to income ratio and you're a first-time home buyer, look at that calculation. And if you're considering an FHA loan, just look that it can go up as high as 45%. Okay. The last type loan would be a VA loan, or a Veterans Administration loan. These loans are for active duty service members, veterans, eligible surviving spouses. Bottom line, if you served in the military and you got out of the military with an honorable discharge, you're entitled to this veterans loan, VA loan. Now, what are some of the benefits of a veterans loan? You've probably already heard about it. Well, the biggest one is it's 100% financing. So on most VA loans, there's no down payment required. Now, we also talked previously about mortgage insurance, that if you put down less than 20%, you have mortgage insurance, right? Well, with a Veterans Administration loan, there is no mortgage insurance. That's another benefit. So even if you put down, if you don't put down any money and have 100% financing, you will not have any mortgage insurance with a VA loan. Okay, VA loans have very low interest rates. They are assumable. They're one of the types of loans, what we say, assumable, meaning if someone wanted to just take over your property, they could assume your existing loan. So these loans are also assumable. That's another benefit of the VA loans. Okay. So that basically ends, all the terms. You've heard a lot of terminology that you're going to encounter when purchasing a home. And I hope that I've provided you information to describe some of those terms and to tell you how those terms work. I hope I've given you information of how to calculate to be able to do a home improvement, home pre-approval yourself, to calculate your debt to income ratio, to calculate your LTV, and to see, how much you qualify, even before talking to your lender. If you have any questions, I'll be glad to ask them right now.
So I don't see any questions at the moment, but we'll give them another minute or two just in case.
Okay.
And again,
And
to
you
ask
have
a
my
question, there's
information.
a question mark button on the right side of your screen.
I'm sorry, say it again.
I was just reminding the audience that if they wanted to ask a question, there's a button on the right side of their screen. It's a question mark, and then that's where they can type in their questions.
Okay, thank you.
All right, I'm not seeing any incoming questions, so I think that will bring our session to an end. Thank you so much, Mike, for your time and your knowledge.
Thank you.